Hey everybody, and welcome to the channel. My name is Brandon, and bringing you today some important facts about the S&P 500. We're actually going to be talking a lot about the S&P 500, what it is, what it has, way to invest in it, just a broad number of things. So if you look right through here, you will see that the S&P 500, okay, it stands for the Standards and Poor's. The S&P 500 index, formerly called the Composite Index, right here, later named Standard and Poor's Composite Index. It began tracking 90 stocks in 1926 and expanded to 500 in 1957. If you want to invest in the S&P 500, you have two main options: buy individual stocks in each of those companies, or buy an S&P 500 index fund or exchange traded fund, also called an ETF. We'll get over those a little bit later. The S&P 500 index acts as a benchmark of the performance of the U.S. stock market overall, dating back to the 1920s, in its current form to the 1950s. The index has returned a historic annualized average return of around 10.5% since its 1957 inception through 2021. However, with inflation increasing year over year, the return might be closer to about 7.2 or 7.8, because when it comes to CPI data, inflation numbers, it's always going to be skewed a bit. All right, another fact here: fairly diversified across all 11 sectors of the economy, given its consistent rise in return, percentage yield its power. Now, as far as the sectors of the economy go, we're going to be talking a little bit more about that in another video that I'm working up for you guys. Explain a little bit about the sectors of the economy, what sort of companies are in the sectors, and how you can diversify. All right, let's move on. Not actively managed by a person or a group, and is considered a passive form of investing, containing 80% of the U.S. economy's market value. Now that's important. 80% of the U.S. economy's market value. Investing into the S&P 500 means you will own shares or fractional shares of all 500 large cap stocks that make up the index. The board of directors can add or drop companies to or from the index depending on the criteria and standards that is to be always upheld. The U.S. Index Committee uses financial health measures criteria to ensure the health of funds and the market overall. All right, now with that being said, what we'll do now is we'll discuss some other facts as far as like criteria, some of the best ETFs that you can invest in. Okay, so criteria required for the S&P inclusion. Now, most companies follow under these strict guidelines, but in order to be in the S&P 500, the SEC regulations, all the committees, all the powers that be, you have to walk a fine line. So with that being said, as you can see right here, a company should be a U.S. company, have a market capitalization of at least $13.1 billion, be highly liquid, okay, which is have cash flow and or assets that can sustain through economic downturn, such as like the pandemic that happened last year, the Russia-Ukraine situation, certain things like that. Have a public float of at least 10% of its shares outstanding. Now this means how many shares that they can release for public trading. Pretty much the definition there of public float. The company must also be profitable in its most recent quarter's earnings, and the sum of its trailing 4 consecutive quarter earnings must be positive. All right, that's very important. And that's also important for a number of reasons. Not only to be included in the S&P 500, but also it gives you a good basis of a company's profitability and if you want to invest in them or not, which can be found on balance sheets and statements. Last but not least, the company stock must be trading at a reasonable price and have been publicly traded for at least 12 months after its initial price off or its IPO. Release onto trading exchanges, pushing it into mainstream market. All right, so the top 10 holdings of the S&P 500. And now this is by weighting. Changes from time to time depending on revenue, quarterly earnings, going on with management. This is something that changes, and it can change from time to time. Top 10 holdings of the S&P 500. Now this is by weighting. So this can differ. This can change. It just depends on quarterly revenue. It depends on what's going on with management. It also depends on what's going on with the economy as a whole. Sometimes companies in the first place might fall 1 or 2 places. Also, companies in the 10th place might go up in ranks. So as of right now, might be a little bit off depending on the time frame. Apple, ticker symbol AAPL for quick find. 6.2%. Microsoft, ticker MSFT, 5.9%. Amazon, big Amazon.com, ticker symbol AMZN, 3.9%. Facebook, also called Meta. I will never be able to call it Meta. I'm just saying that right now. Ticker symbol Facebook, 3.9%. Alphabet Incorporated Class A, also known as Google, 2.3%. Alphabet Incorporated Class C, ticker symbol GOOG, 2.2%. We can get a little bit more about the classes in a later video. Tesla Incorporated. Everybody knows Tesla. Love Tesla. TSLA is the ticker, 1.5% of the weighting. NVIDIA Corporation, ticker symbol NVDA. I'm sure you know about NVIDIA. If not, you can probably look down at your computer right now and you'll probably see a sticker with NVIDIA software that's or hardware that's all through your computer. 1.5%. Berkshire Hathaway Incorporated, Warren Buffett, 1.4%, JP Morgan Chase and Company, big bank, JPM is the ticker, of 1.3% weight. Now, a total of 30.1% of wealth in the market is held by these companies. So take a good look at this right here, and the majority of the money that's flowing through the United States right now is through these companies. Good fact, it's definitely something to be aware of and to know what sort of companies are leading the markets. All right, now this is a fun one to talk about when it comes to the S&P 500. I'm invested in a lot of these. These have very stable returns over the years, and it's very hard to beat the market. Some of these ETFs have an annualized return of a certain percentage that's very hard to beat. Even hedge fund managers, seasoned investors have a hard time beating these certain ETFs. Let's take a look at that right now. The top 5 ETFs that track the S&P 500. So you have the SPDR S&P 500 ETF Trust, spider right here. Ticker symbol is SPY. Vanguard S&P 500 ETF, VOO ticker symbol. iShares Core S&P 500 ETF, ticker symbol IBV. Vanguard Total Stock Market ETF, VTI, ticker symbol. Invesco QQQ Trust, ticker symbol QQQ. Investing or diversifying amongst these 5 is a very safe, passive way to invest. It is something that you can throw $100 a week, $1,000 a month, or whatever you are able to do, and let it sit for a course of 10 to 20 years, and the returns, the compound interest, would be ridiculous for you. Very low risk, very low management, and great returns for your future. These ETFs are a mix of tracking the entire market or certain sectors of the market by assets under management, also known as AUM. AUM equals the total market value of the investments that a person or an entity handles on behalf of the investors. So just know that these are ETFs. They're like having basically a basket. So you have a basket. Instead of having, just a big bundle of apples, you have a basket of apples, bananas, pears, oranges. You have a mixture of everything, just in case if it's out of season for apples or out of season for oranges, the bananas and the pears will be ripe and you'll have plenty to eat. That's the way these ETFs are designed. That's the way they are made to kind of diversify and make it to where the whole ETF or exchange traded fund is not as risky as owning an individual stock or an individual bond. So I hope that this helped.